This is the current federal tax developments for the week of May the 5th, 2025. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, and I'm coming to you today from here in Phoenix. We're going to talk about a few things that went on in the past week in the area of tax. We'll begin by talking about an IRS memorandum that discusses what happens to when you have a multiple employer filing, like from a payroll service, similar structure, where they are filing on behalf of multiple employers. What happens if they submitted an ERC claim but didn't include Schedule R? It's not going to be a good answer, but we'll talk about that. We're also going to talk about a taxpayer who attempted to claim they had reasonable cause for not reporting a bunch of payments in cash above $10,000 in their business, with the required reporting within the time frame, because they had purchased software to supposedly solve this problem, and they argued the software made mistakes. We'll talk about how the court reacted to that and what you might need to worry about if your client has issues like that going forward. We are going to talk about, we are now in the time frame when, remember, the Congress has started the reconciliation process. And we actually have had a few things, not yet in Ways and Means, but in other House committees that have been proposed that are tax issues, including the potential First Amendment to PL 86272's restrictions on states taxing the income of out-of-state businesses, on the income tax rules. The First Amendment, since it was enacted in 1959, is now on the table. Whether it becomes law or not, it's open question. We'll discuss what they're talking about doing to it. And the IRS did issue, as they always do, early in the game. We have our first inflation-adjusted numbers for 2026. And as always, these are the adjustments for HSAs and accepted benefit HRAs, as well as the high deductible health plan rules that are important to allow you to get an HSA. So we will talk about that kind of background. So let's begin talking under a program, basically a PTMA 2025-001 that was issued on April the 25th of 2025. Well, it was published redacted form. It was actually issued back in February. And this is a note, essentially, inside the IRS discussing the validity of an employee retention credit claim that was filed by an organization, essentially, that is, let's say, a payroll service or a similar organization that you're leasing employees from, et cetera, things like that, that normally would go in with a Schedule R, but in essence, when they did the ERC claim for multiple employers, their clients under that group for their filing, they failed to attach that. We're going to kind of talk about what that issue is. Now, the IRS issued this Program Manager Technical Advice 2025-001, and it was with regard to employee retention credit claims, ERC claims. And it's focused on claims that are submitted by what the IRS puts in this category, third-party payers, TPPs, that are using their own EIN on aggregate forms 941 or 941X filings, right? So they have a overall broad one, and normally as part of that, they attach a Schedule R that breaks down for each of their clients, their share of these items. Now, the context of this, there was a moratorium put in place on processing Form 941X because there became significant concerns that there was an excess number of ineligible ERC claims. In fact, TIGTA basically roasted the service for not reviewing these adequately enough during that time frame. So eventually, with the flood of amended returns and with this criticism that they were paying out ones that by now appeared to be clearly questionable on their face, they put in a moratorium. Okay. Now, the problem we've got right now, because that moratorium then set us for quite a while with nothing happening, a lot of these third-party payers failed to attach Schedule R of Form 941 to these, aggregate filings, just a whole group, all their clients, when they were claiming the ERC. So they didn't tell us, how you broke it down between the various customers they had. Now, Schedule R, the IRS had told us, and this goes back to the information on the FAQs back in 2020, eventually was formalized, and it was 2020-120 after we revised the whole program and allowed you to have a payroll protection program loan and still get the ERC, so all those amended returns. So also the 941X instructions also told you have to attach a Schedule R, allocate the credit or refund to each client. This advice noted that the IRS has identified at least 2,700 third-party payer amended returns that are lacking Schedule R. During the moratorium, they noticed this problem. So these had been filed without a current Schedule R. This memo is looking at what's the status of these things. Well, this PMTA is specifically addressed at 4 key questions. They're trying to answer it. Is an aggregate Form 941 or 941X without a Schedule R a valid return for their clients? Secondly, if it's not a valid return, is it a valid formal claim for refund? Right? Does it meet the requirements for a claim? If it fails the formal requirements, is it still a valid informal claim for refund without that in there? And finally, even if it fails all that, does it qualify as a sort of protective claim for refund? So those are the 4 key questions. Hint, the answer is going to be no to every one of these per this memorandum. So you may not agree with that answer. I think there'll be litigation over that answer, but it's currently going to be the service's answer. So that appears to be where we're at. Now, how the IRS come up and analyze this? Well, they took a look first to test on validity of a tax return. They went back and looked at the case of Beard versus Commissioner. And they said under basically the precedent we have in the Beard case, there has to be sufficient data on there to constitute a return. It has to purport to be a return, has to be an honest attempt to fulfill the requirements for return, and must be signed under penalties of perjury. If there's substantial compliance with it, right, then that starts limitation periods on, filing returns, doing other issues. So formal returns in play. Now, for a formal claim for refund, you look at Treasury Regulation 301-6402-2A2. That requires filing on a prescribed form and adherence to instructions. As you might guess, that's going to be a problem here. And 301-6402-2B does also require facts sufficient to apprise the IRS of the basis for the claim. Now, informal claims, they go and they cite the Supreme Court case of United States versus Kale, and it requires a written component, notification to the IRS of the refund sought, and focusing the IRS's attention on the claim's merits. Now, to be totally honest, I think the most likely one of these to succeed is an argument that this is an informal claim for refund. But as I say, that's not going to be the answer this memo is going to come down to. So keep that in mind. Now, on a protective claim, they obviously looked at Ambase versus United States, and again at the Kales case. In this case, that's used to preserve your right to file to get a claim for refund contingent on future events taking place. Now, the guidance we had, the third-party payers and on ERC matters, that IRC Section 2301L3 directed the IRS to issue guidance in this area. Notice 2021-20 with question and answer number 62 specifically required third-party payers, including those who don't typically file Schedule R, to attach Schedule R to 941 or 941X when claiming ERC for clients. Schedule R must allocate the credit to each client. Now, main reason for that was that, as the IRS would say, okay, how much payroll you paid, that may be one thing that we could figure out here. But what we can't figure out from here is, remember, each of the employers, your clients, would have to qualify either by having a reduction in revenue sufficient for whatever testing period we're using here, or having a partial suspension with a government order. Now, those facts have to be tested at the individual client level. So this is a key reason why they said we have to have things broken down by client. We can't just take your big group and treat them as one big happy family that will all qualify, all not qualify. That, we needed the Schedule R information. So that's going to be the services justification there. Now, their application of these facts to the law. First, is a return valid? An aggregate form 941 or 941X fails the Beard's test of data sufficiency without Schedule R. The IRS cannot identify the clients or allocate the taxes or payments. This is not a valid return for clients for 6501 purposes. Now, why that matters is, remember that since that's not a valid return for those purposes, we have a bit of a problem of we never really filed the claim. Wasn't a return, it didn't get things going, and we may have other problems. Now, on a formal claim, they say a Form 941X without Schedule R fails to meet the requirements of the Treasury Regulation 301-6402-2. You didn't follow the instructions and apprise the IRS of the facts necessary to make a decision here, right? You didn't apprise them of the basis for each client's claim. And without that, it fails. You didn't follow the instructions and you didn't give enough information. Therefore, because the IRS doesn't have the basis for each client's claim, and that has to be where the test takes place, the IRS rules this is not a valid formal claim. I pretty much am with the IRS there. No problem there. Now, an informal claim without Schedule R, the IRS says that lacks sufficient info on a claim basis for each client. They're going back to this again. They cannot focus on the merit of each individual employer's eligibility. Therefore, it is not a valid informal claim. This one is probably going to be one that will be disputed in a lot of cases, especially depending upon what data was submitted with the form. What information was there? Were all their customers restaurants in a location that simply shut down restaurants, for that period or greatly limited them? Is it going to be kind of the obvious situation versus maybe something more complicated? But yeah, I would expect if litigation comes on this, we're going to see a strong argument that at the very worst, this was an informal claim. Now, on protective claims, I think they just raised this for total coverage. But a Form 941X without Schedule R does not meet the criteria for contingent events. There's not really a contingent event we're talking about here. What's a contingent event? Right? Traditionally, you do protective claims if you're filing for something where a future event might do it. Like an example I would give prior to getting the relief we did earlier this year was, people that worried about, well, what was going to happen if I file an ERC claim, and I have to reduce the wages for the taxpayer for the period I do for the amount I'm claiming as ERC. What happens if the IRS doesn't approve the amount I did and I've already gone and paid the tax on that? And that statute could close down on the income tax side because Congress made the frankly not very forward-thinking decision to have the credit paid under payroll taxes and the reduction of deduction under income taxes. That'd be the case where you'd use a protective claim. Awaiting the IRS's determination on how much of the claim they're going to pay, we want to essentially file a claim for refund, potentially all the way up to the amount of the reduction of wages we took, so that if it turns out we don't get some or even all of the claim allowed, that we will be able to go back and amend and claim back our income taxes that we overpaid. That'd be a protective claim. This is not really a contingent situation. I don't really see how you're going to argue that this was a contingency. So a lack of a Schedule L prevents the IRS from knowing which clients are covered. That's not a valid protective claim. Now, I should say, among the third-party payers, right, those who were, kind of in that area, there were a lot of complaints that the IRS had been very slow and not very reactive to their filings. So this is probably not going to make them happy, right? We're going to be in that background. Now, the IRS says their conclusions here apply both to original 941s and the more likely 941Xs that were involved in this case. So they're saying essentially you're out of luck if the statute's closed because you didn't keep the statute open with any of these. None of them will give you a currently open statute. So this guidance retroactively emphasizes the critical nature of Schedule R for TPP ERC claims. And one of our problems is it is retroactive, right? We didn't, even though they had this ruling internally in February, it wasn't actually released until after April 15th of 2025. Now, I understand it has to go through the redaction process, etc. They'll claim there was nothing unusual going on there. But the reality was that in February, you could have still, at least for 21 claims, have gone back and filed a new updated claim and put a Schedule R in, because had that gone in by April 15th of 25, that would have been a timely claim for 21 941s. Because remember, all 941s for the calendar year are treated, as long as they're filed no later than April 15th of the year following, as essentially being originally due on April 15th of the year following. That's the date the statute runs. So yeah, conveniently, this didn't come out until a few weeks after the deadline had been blown away. We're past April 15th. Now, the IRS position is the absence of Schedule R renders the filing invalid for the clients, regardless of whether it's an original return, an amended return, a formal claim, an informal claim, or a protective claim. None of those will work. They're all wrong in that area. The IRS views Schedule R as essential for identifying taxpayers and being able to assess the ERC eligibility of each of those taxpayers, which is key to getting the ERC within an aggregate filing. Now, the big problem, of course, as I just mentioned, the statute of limitations for most ERC claims has expired. It'll be an unusual case where it hasn't yet. And so filings without Schedule R are not considered valid claims to return. And that potentially means that any clients, any of their clients that had claims under them they'd filed for are just now going to be out of luck. They're not getting an ERC payment because it had to go through a third-party payer. If a third-party payer didn't attach a Schedule R to show, each employer who would qualify for what, IRS says, well, tough luck at this point. And remember, we are told by the IRS in this memo that they had identified during the moratorium 2,700 such claims. Now, they didn't tell us how many of those they might have reached out to and said, hey, you got to update this. But I suspect not many of them. And so that's an interesting problem. That, in the time they went to go ahead and try to make this ruling and tell us what's going to happen there. So this one will be more interesting to watch. We'll see if we get litigation here. If you have a client in this position, where your client was with a third-party payer, and now we discover that their claim was defective, yeah, things get real interesting. So we'll keep our eyes, see what happens. Next up is a tax court case, Tax Memorandum Decision 2025-38, that came out on April the 28th. This is Dealers Auto Auction of the Southwest, or just of Southwest, I guess it is, LLC versus Commissioner, right? And it deals with penalties for failing to file information returns and whether you can get out of, for reasonable cause, those penalties by saying, hey, we were relying upon third-party software, and, the issue, can you? Now, the interesting part in this case, you'll find out the answer is yes, it's theoretically possible to have a situation where a third-party software error could be reasonable cause. But As we'll discover, it's not the facts in this case. There it'll be. Okay, this background for this one. Dealers Auto Auction of Southwest LLC was an Arizona LLC. It operated an auction house. Okay? So they basically were auctioning off cars. Now, because in this business, people will come in there and pay cash at the auctions for the cars, they ended up having to file Form 8300, a report of cash payments of over $10,000 received in a trade or business. Because again, remember, if you receive $10,000 in a single payment or as a series of payments, related payments, you have to file that form under very short deadlines with the IRS under Internal Revenue Code Section 6050I. Now, they'd been burned on this once before. In 2014, they got caught on exam for failing to file and furnish the required returns. And you're penalized both for not filing the return with the IRS and with not providing a copy to the party that paid you. So you get a double whammy here, like you do with a lot of information return. So they ended up with proposed penalties totaling $21,200 for that year under Section 6721 and 6722. In response to those failures, they purchased software called Auction Master from Integrated Auction Solutions, IAS, to assist with reporting, including doing Form 8300. It did many types of reporting things that are going to help them, but it would do these Form 8300s. Now, the software was promoted as IRS approved. The manual indicated that it could track and print the 8300s. Now, of note here, doesn't appear anything that was submitted in this case never really said it would file them. So we have to kind of, keep that in mind as to what was going on here. Okay. Now, for the 2016 tax year, so 2 years later, the IRS again came in looking, and they determined that Dealers Auto failed its 6050I obligations again. Now, the software system they had generated 116 Form 8300, which these guys filed. But on exam, the IRS found an additional 266. Yeah. Basically, over twice as many forms that should have been filed that weren't than forms that were filed. That penalty, in this case, we got a lot worse at this point. The proposed penalties for this failure would total $118,140. And part of that is you're going to get the book thrown at you because, remember, you were told earlier about this problem and you still didn't actually get it working. Now, the taxpayer argued that they should get a reasonable cause penalty abatement. They claimed their failure was due to reliance on the software, which they alleged did not perform as intended. The term they used, they said there was a failure with the computer system. Now, the IRS challenged this penalty liability in the collection proceedings when the appellate conferee sustained the lien and stated that software of Reliance is insufficient without checks on that software. The taxpayers then took this case to tax court. So now we're going to tax court. We're going to see, is this reasonable cause? Can they get out of $118,140 proposed penalty? So let's talk about the legal framework behind penalties and reasonable cause. IRC Section 6050I requires filing Form 8300 for cash received over $10,000, either as a single payment, and it can be cash or cash equivalents, or as a payment that is part of a series of payments that eventually total over 10 grand. So you can't just structure it by paying $5,000 and then coming in a day later and giving another $6,000, right, to complete your purchase of the car on auction. That's not going to work. Now, these penalties can be on 6721 and 6722 imposed penalties, $250 per failure. Now, there are caps on them, but they're well below the number that's being assessed here. For failure to file or furnish, and there are some adjustments and limitations. But under 6724A, this penalty does not apply if the failure is due to reasonable cause and not willful neglect. This is what the taxpayer is hanging their hat on, in this case, is that they should qualify for that. The IRS interprets that in Treasury Reg 301-6724-1. And reasonable cause exists with either significant mitigating factors or events beyond the filer's control if the filer acted responsibly. Now, mitigating factors, they said the court found that they don't have mitigating factors because they had a prior failure. They'd been here. They've been told about this, right? It's not like they're a poor, ignorant taxpayer who didn't know. They shouldn't have known. Their training, wasn't sufficient for them to know. Then you might see that as a mitigating factor. The taxpayer did as well as they could. So the next case was, did they have events beyond their control? And this can include certain technological failures, like a major hardware and software problem. Now, the IRS was claiming, no, those could never count. But the court said the Internal Revenue Manual, your IRM, says they can. Now, while the IRM isn't binding, the court said, we agree with that. A software malfunction can qualify if you were using the software correctly and it simply failed, right? And, especially when we talk about things like electronic filing in some cases, it could fail in a way that might be difficult to detect. For instance, I'm just thinking about, we talk about things like tax returns and acceptances. What if your software somehow, when it got the acceptances returned to it, just fouled up and, flipped the switch on a buggy version, and you were told, this return was accepted. You send that out to the client saying, hey, this return's accepted. Turns out it wasn't. It never went through. It never actually even got uploaded. So, that would probably be a case of events beyond your control, which could give a reasonable basis for not having done something. Now, again, the e-file bit here for a tax return, that's not really covered by this here. Different issue, but same sort of issue. Now, the IRS also argued the duty is non-delegable. And it goes back Supreme Court's case, United States versus Boyle. Remember, we bring that up all the time when a taxpayer, CPAs will ask about the problem. What happens if you discover you forgot to extend somebody? Right? We forgot to do an extension for Harry. And turns out Harry had a balance due. And of course, we don't figure this out until when he finally drops stuff off the end of September. And now we're now going to go the whole 25% limitation. We're up the whole thing. What do we do about that? Well, is it reasonable cause to say, the CPA just fouled up and then filed? No. Supreme Court said in Boyle, that's not reasonable cause for the taxpayer to get out of the penalty. As we all know, primarily means that they're going to, though succeed in state court, in having a jury decide that the CPA is responsible for paying the penalty, even though they can't get out of the penalty themselves. So that'll be it with Boyle. Now, the tax court said they're distinguishing Boyle in this case. The taxpayer claimed the software malfunction prevented knowledge of the need to file. They didn't say they delegated the filing itself to the software. So they're saying, no, we don't think Boyle's here. So we don't see this as a delegation issue. And we do agree that a software malfunction in the right fact pattern could serve as an event beyond the taxpayer's control that could give you a reasonable basis for the failure to file. As I noted, it's not really this case. The tax court held that dealer's auto failure to establish reasonable cause for two big problems that they think showed that there was not reasonable cause. First, they failed to show what the software malfunction was. They didn't provide sufficient evidence to show the software failed to work as intended. It was unclear if the issue was it didn't create the forms or they thought it filed them and it didn't file the forms. It's not clear at all. And while they did have literature from the vendor suggesting, later versions of the software had improvements, they didn't mention that it corrected existing problems in the version the client had. So all we have is a flat out claim, the software malfunctioned, but we're not sure if it's a malfunction or if it's a misuse. The client just didn't take the time to understand and properly use the software. Is that the problem for this case? Again, They didn't establish that. You need to establish what went wrong, because the court wants to know is, should you have noticed that? Is that something that you should have been aware of? Were you aware of what you were looking for? Because, if you misuse it, it's not reasonable cause to fail to file your tax return. If in fact you just never read the fact that the tax software you're using doesn't automatically upload to the IRS. You have to say, go do this. You failed to read the instructions, not really going to qualify you for, saying it's a software malfunction. They also said, here's the other problem. They should have figured out there was an issue going here. There was a significant drop in forms generated in 2016. In 2014, the IRS had identified at least 212 returns that should have been filed. Now we're down to just over half that many that identified in 2016, the year when they started using the software. They should have wondered why it was coming up with so many fewer. Was there some major change in their business, some other issue that would explain it? They really didn't know. They hadn't noticed the drop, right? They didn't take reasonable steps to ensure compliance or verify the software's function. And the fact that it was doing so many fewer than they knew was the right number for 14 is something they should have followed up on. You cannot play ostrich and just bury your head in the sand. And that's what they say basically this entity did. It should have noticed the problem. It was given warning in 2014. It knew what the numbers should be from 2014, what they had done. When their fix was only generating about half the number of filings that they'd had in 14, you got to ask yourself, really, has everything changed so much since then? Or is it possible we're missing some? So some key takeaways here. Entities generally bear the burden of proving reasonable cause for penalty abatement. So you got to show you have reasonable cause for doing it. And software is not a magic bullet, which I really think was the problem here. It happens, unfortunately. I really think here it may have been an innocent mistake. The taxpayer thought, oh, we got this problem. Clearly, we don't know what we're doing. So we're going to go get this software that claims to take care of filing this. And now, problem solved. We don't need to worry about anything. We just bought the software. They didn't really make sure they were using it correctly, right? They didn't make sure they understood it. And, it's kind of a problem, right? It's not a reasonable cause defense. They have to show that they were using it correctly and the failure was due to an unforeseen modification. And one of the problems we got with unforeseen here is they should have had a clue there was a problem by the reduction in number of reports that it was coming up with to file versus what the IRS determined back in 2014. And due diligence is important here, especially in a case like this. You must exercise due diligence in setup, training, accurate data input, and verifications of output and filing processes before you have any chance of succeeding on claiming a software malfunction should give you reasonable cause for not filing. You should have every reason in the world and have taken reasonable steps to ensure that it was going to do it properly. And then potentially, let's say if it had failed to file 10 reports. Okay, that might not show up. It wouldn't be that far off. And, as long as you had trained and you'd gone through it, you'd paid for the training from the company, you'd gone through it, you had your outside CPA or EA or whatever look at this, and say, yep, I'm looking at this. It appears it's picking up everything it should. That would be fine. And by the way, that your staff is actually inputting into this right, which also could be a problem. Internal controls are big. You need to implement and maintain adequate internal controls to identify compliance issues, to demonstrate responsible behavior. Did you have controls to make sure your staff was properly inputting the stuff into this system? Because again, software is garbage in, garbage out, right? If people aren't putting in or using it properly, then it's not going to perform properly. That means you should have systems in place to help ensure that people are using the software properly. Documentation is crucial for this case. And the real problem here is they didn't have documentation of any of these. They didn't document how they use the software, didn't document the training they did, didn't document any issues they had run into and how they resolved them. And they didn't document their communications with the software provider, and how they had discussed this issue and how it resolved. Again, all they had was very vague things, and they were simply saying software malfunction. They didn't bother to try to figure out, how did this happen? That was the problem. And atypical results, like a dramatic reduction in the number of reports being generated, that should have triggered investigation into what's going on here. Why is this happening? In this case, it didn't. And unfortunately for the taxpayer, it's going to be very costly. Right? $118,000+ that is required to be paid over because they didn't take the steps to ensure the software was properly functioning. Next up, we're going to talk about, probably not for the last time over the next few months, the process of the reconciliation and a tax provision which popped up not in Ways and Means, and this happens here from time to time. It'll pop up in other places. This is a proposed expansion of a 86272 exception. And this is House Resolution 427, which has now been picked up and incorporated into the portion of the reconciliation bill that's coming out of the House Judiciary Committee. And this came up on April the 30th of 2025 is when this came down. So let's talk about 86272, Public Law 86272, a 1959 law that was enacted to attempt to block what had been a court decision that allowed a neighboring state to tax, for income tax purposes, activities of a company that merely had salespeople in the other state. They were in one state, but they had sent, just salespeople to do sales, outside salespeople to go into that other state. But they didn't have any inventory there. They didn't have any operations there. All orders were approved back in the other state. So PL 86272 was meant to restrict that so that these states couldn't tax. There wouldn't be this rapid expansion of income taxation of entities in other states. Now, this law limited the state's powers to impose income tax on income from interstate commerce. Congress has the right to do that. They can control interstate commerce. The problem we've had in taxation at the state level always has been Congress has not done virtually anything with their ability to regulate what the states can do about interstate commerce and imposing taxes in that situation. As such, we've been left with a series of Supreme Court cases and the concept of the, quote, dormant commerce clause, which is what happens when there's something that impacts interstate commerce, but Congress has not themselves taken up to regulate it, and we have this whole line of cases on the dormant commerce clause. And to be honest, the current Supreme Court does not seem to be a big fan of it, which is technically bad news for you if you don't want to pay taxes to the other states, because they're saying Congress needs to step up and do something here. It shouldn't be up to the courts to patch, where Congress doesn't want to do something because it would be politically problematical, which is why we don't see these. Because anytime you try to restrict the state's ability to tax something, that negatively impacts their income. And since there are senators from that state, et cetera. And by the way, remember, these are states getting their taxes from entities outside the state. So that's always popular with the voters, right? We'll take that, right? You're not going to impose a tax on them. You're going to go back and get these people from out of state. We don't see Congress impose this very often, right? We haven't actually seen the senators and representatives from South Dakota going around saying we got to change the world due to the Wayfair case. Remember, South Dakota was the winning side in Wayfair sales tax case. So Congress doesn't tend to move on this. Now, this protection, this is an income tax only item, applies if the only business activity in the state is solicitation of orders for the sale of tangible personal property. It was written very narrowly. And considering that we really haven't had anything else since 1959, maybe consider a minor miracle that this one got through. But it did. But remember, it's got to be solicitation of orders has to be your only activity in the state, and it's got to be the sale of tangible personal property, not services. Services aren't covered by this. The other conditions are the orders must be approved, rejected, and filled from outside the state. And up to now, Congress has never amended that original 1959 provision. So PL 86272 has remained as is. Now, the funny part was a couple of years ago, there was an article written, I believe it was Annette Nellen who wrote the article, from Golden Gate University, that pointed out that this was a law that was meant to be like a 6-month patch, and Congress would write a more comprehensive law. They never got around to doing that. And so this 6 months patch has now been enacted in the law and in place at this point for over 65 years. Yeah, it's old enough to get Medicare at this point. Now, the current interpretation depends heavily on a Supreme Court case of the Wisconsin Department of Revenue versus Wrigley. This is a case from a number of years ago, and Wrigley was the chewing gum people, right? So in this case, the Supreme Court interpreted what is solicitation of orders. What can you do that will qualify as solicitation of orders? And what if you do it goes beyond that and now suddenly allows the state to tax you? By the way, Wrigley lost this case, so be aware of that. This is how it goes. It only includes activities that are strictly essential to making purchase requests. And that includes entirely ancillary activities. Ancillary activities related to sales, but that only relate to these sales of tangible personal property. They have nothing else, no other usefulness there. They have no independent business function apart from their connection to solicitation. There's even the least other connection. Under the Wrigley theory, the state would appear to have the right to tax it, and the Multi-State Tax Commission has been suggesting there are lots of ways, due to internet functions, that you could find that there are other activities going on within the state that are not strictly essential to the making these qualified purchase requests. Okay, that's going to be key issues. Now, this interpretation has faced a lot of disagreement, especially as you have the internet modern activity. Remember, a number of years ago, we talked about the state of Massachusetts, it was, with cookie nexus in the browser. If a company places a cookie on the browser of a customer in the state, which they'll do if they order online, there'll be a cookie there with your account. Whenever you go, like, let's say to Amazon, and you go to place orders there, yeah, they have a cookie. They have a cookie for no other reason than that's the only way to really keep track of the same session that you're in, that you're the person looking. You were the person who had that, let's say, new laptop on the screen, and who then clicked the buy button. And so when you then go to the page to, give your credit card and other information, the cookie allows, Amazon to keep track of this new page requested is actually related to the same session. Well, Massachusetts was saying effectively, if they put a cookie on your machine, they are putting a cookie on the hard drive of the customer. They would argue that was no longer strictly an ancillary service, be part of the arguments you'd have for that. So we were getting there, and it's starting to say that there would be essentially no way to qualify for this relief for almost anybody that had any sort of modern business practices. Customer in the state's going to cause you to have to file in that state. That's going to be your background. And now, to be honest, I've talked with people in state and local taxation specialists who have said tongue-in-cheek that if you think you qualify for the 86272 exclusion, you'll almost certainly find the state you're talking to doesn't believe you do. And frankly, there's probably a 90% chance you don't. In essence, it's not great protection. It's very limited, it's very restricted, and it relates to how things worked in 1959. So it has lots of issues today. Right? So what's the proposed change? HR 427 was introduced standalone bill in January as the Interstate Commerce Simplification Act of 2025, and it would amend Section 101D of PL 86272. Now, it's getting rolled into this, basically, into the big budget bill for the simple reason that it would allow it to go through the Senate without needing 60 votes. So if it's in the big package and it's ruled to be relevant, which it would appear it may be, we'll get into that whole long argument too shortly about how that one works. But, we'd be in there, then it would be allowed to be passed and you wouldn't need to get 60 votes in the Senate, which probably for anything like this related to restricting the states will be utterly impossible. Now, I'm a little skeptical whether we can get 51 votes in the Senate because of the way the states react to this. But, we'll have to see. In essence, at least the House believes they might be able to pull it off. Now, this would add a new paragraph defining solicitation of orders. And it would say solicitation of orders would mean any business activity that felicitates the solicitation of orders. And that would include activities, even if that activity may also serve some other independently valuable business function apart from solicitation. So it would stand it on its head. It's no longer that you have to show that this ancillary activity only benefits outside sales orders. Now, if it benefits outside sales orders, then it's fine doing that, even if it benefits other things. So it basically opens up and makes this a way broader exclusion. So that would be a huge difference. It could make a big difference about whether or not a state would have a right to tax income tax. We'll obviously have to see the states would interpret this and how things go forward. Oh, and by the way, we also have to wait and see whether it becomes law. Because again, as I said, I don't know that they're going to get 51 votes for this. I would fully expect there's going to be at least some attempts to strip this out. Now, this proposed definition is directly opposed to, honestly, what we found in the Wrigley analysis. No longer does the ancillary activity have to be solely useful for these outside sales purposes. By including activities of independent value, it basically usually expands what will qualify as protected solicitation of orders, right? As long as it works to help solicitation of orders, it can do anything else, apparently, under this paragraph. So it'd be a big expansion. It'd bring a wider range of in-state activities under the protection of the immunity. So it would seem to be fine. And that's where we get to ancillary becomes a much bigger category. This could also make it much tougher for the states to be able to say, hey, wait, there's a service here, right? Because, well, maybe, but what we're doing here, overall what's happening here is ancillary. It's ancillary. So while it still independently helps us sell services in that other state, it doesn't matter because, it helps us sell products that are protected, the tangible goods and services. So the result, if this were to pass, is we would expect out-of-state sellers could perform more types of activities in the state without losing immunity from the income tax. And it would potentially greatly limit a state's authority to impose that income taxes based on such activities. So, yeah, it's an interesting question as to what it would do. Remember, we're flipping it. Anything we do in the other state, as long as we can show that it benefits solicitation of orders in the state, would apparently be okay. Does those solicitation of orders, it facilitates that, we're good. Now, it was introduced initially on January 15th of 2025, and it was referred to the Judiciary Committee in the House. The provision is now included as part of the House Judiciary Committee's budget reconciliation bill provisions that they're doing. Most important thing to note, it's not law. This is not currently law. But this is the sort of thing, as we go through the reconciliation process, you've got to watch for what gets added. right? There will be other tax provisions coming in, and not necessarily limited to the ones that I think everybody was talking about ahead of time. A lot of people were discussing the fact that, we expect an attempt to get rid of taxing tips. We might see go back, get bonus depreciation. We may be able to go get, restore the old rule for Section 163J for interest. All of those things, get the research stuff back together. And I guess one other proposal that the current president made while campaigning would be to allow some sort of deduction for interest paid on car loans. So, but this was, nobody was out saying we're going to do, in essence, modify the old public law 86272. So you'll see these things come up, especially if a committee just, thinks it's something they like to see happen. So we'll have to see how this moves forward, but keep an eye on it. Finally, on May 1st, we had the issuance of Revenue Procedure 2025-19. And this will give us our 2026 inflation adjustments for health savings accounts and accepted benefit HRAs, which will include the amounts for high deductible health plans, the amount of minimum that you have to have have as a deductible in those plans for them to qualify, and the maximum out of pocket that can be paid under those policies to be qualifying. Now, this is always the first inflation adjusted set of numbers we get. It tends to come right after tax season ends, as it did this year. And, it's very early. So this is just the annual update. 2025-19 Revenue Procedure provides these numbers, right? And these adjustments are mandated. They're inflation adjustments that are found by the Internal Revenue Code, Section 223. And for accepted benefit HRAs, they're governed by Regulation Section 54.9831-1C8 of the Pension Excise Tax Regulations. Now, this ensures that the dollar limitation and definitions remain relevant over time, right? They're going up because inflation's going up, right? The numbers are going up. Now, you might, I'm sure some people might have preferred, if as long as the employer is paying for the health care plan, the high deductible plan, had the deductibles not been going up, but that's it's happening. And the out-of-pocket goes up too, that you have to pay. That's part of all of this, but it was part of how, in essence, all of this came together, is how we do it. Okay? Now, under Section 223B2, there are annual limitations on deductions. This one we like, inflation adjusted. How much can you put in your health savings account? An individual has self-only coverage for 2026. That number is going to go up to $4,400 as the amount they can put in. Realize, even if your deductible is less than $4,400, which it can be, we'll get deductible numbers here shortly, you still can put $4,400 in. If you're an individual with family coverage, it will go up to $8,750. Yes, due to the quirky way the inflation adjustments, they're based on starting numbers, there are times when you're going to find that, as in this year, the family coverage number is not twice the self-only number. So a kind of a minor marriage penalty, shall we say, if you had a married couple do this instead of having family coverage, but that's kind of how it goes. Now, this definition is crucial to be able to contribute to an HSA, is what is a high deductible health plan. For 2026, to qualify as a high deductible health plan, HDHP, it's got to have a deductible that's not less than $1,700 for self-only coverage and not less than $3,400 for family coverage. So those are your bottom, basically the lowest possible deductible. Now, I think, at least for many of us in smaller businesses, going out and getting policies, it's like, yeah, I haven't seen a $700 deductible in so long, right? Deductibles are well above that limit. So, but if you are right at the bottom, then yeah, you can go, you'll go up to $1,700 in 26. Now, the other limitation is out-of-pocket expenses, excluding premiums, cannot exceed a cap. And that cap is going to be $8,500 out of pocket for self-only coverage, again, not including the premium, and $17,000 for family coverage. Now, this out-of-pocket includes deductibles, co-payments, and other amounts, but excludes the premiums. That's the maximum amount. And They can limit it to in-network generally and various other special rules, but they got to have, in essence, once you've spent this much and you've used all the approved providers, that's the most you need to spend. You're done under the plan for that works. Now, if you have an accepted benefit HRA, these are very, very limited, right? They have to be benefits that you're allowed to get, have other coverage for, and won't disqualify the high deductible health plan, right? In 2026, the maximum amount that can be put in that for the year for the employer can make available to the employee will be $2,200, right? Again, this is found in Regulation 54.9831-1C38. And if you go under B1 there, they'll tell you the method that's used to calculate this limit every year. Now, the effective dates of this, the HSA adjustments are effective for calendar year 2026, so they'll start then. The accepted benefit HRA numbers, because that relates to a plan year for an employer, it will take effect, 2200 takes effect at the beginning of the plan years for that employer that begin in 2026. You have to look at it from that standpoint. Well, this has been the current federal tax developments for May the 5th, 2025. We're in May. Oh, yeah, and we're now less than 2 weeks away from the due date for the not-for-profit 990 calendar year filers. So keep that in mind. Deadlines are still coming, right? The last big deadline for a calendar year set is that one, unless you're going to count 5500s, which will come up at the end of July. I used to do way more 5500s than I do now. So yeah, don't really have, in fact, I don't know I'm doing any anymore. I think it's been a while since I've done a 5500. Used to do a ton of them. That was old times long ago in Phoenix. And we can talk about the heydays of defined benefit plans from the 80s. We were doing things like that. This has been Current Federal Tax Developments for this week. Again, you can email me, edzallers@currentfederaltaxdevelopments.com. If you have any comments, questions, etc. Also, I do follow along on websites of certain CPA societies. So you'll find me on the Arizona, New Jersey, Illinois, Minnesota, Idaho, and Washington Connect sites. I'll follow things in those places. So if you have any questions there, I might see them, and I may, if I think I can be helpful, choose to answer something. So you can keep your eye out there. But otherwise, we will see you back here next week when we'll talk about whatever has been going on in the area of federal taxes during the coming week. And we may see if any other committees give us anything for purposes of seeing if any other surprising things are popping up in the potential bills that will come out for the reconciliation process as it moves through the House and Senate. Otherwise, we will see you next week.